Alrighty, welcome back everybody. Giving it a second to let everybody get pulled in here, making sure on my end that my audio is broadcasting. Looks like I've got some levels coming through, so we should be good to go momentarily. Like I said, just going to give it a moment for everybody to get pulled in here from the waiting room. Timothy Jackson says, "Hi Chris, how are you?" Good, good. How are you? Can you hear me okay? My sound check victim. And City, I am good. You sound great. Wonderful. Good. All right. Well, perfect. Then we're going to go ahead and get started. Welcome back, everybody. Hope everyone is having a wonderful Monday today. It is Monday, the 26th, 2018. Today, we're going to be starting off by taking a look. I'm sorry, we're not going to be starting off. We're going to start off actually by going through the disclaimers as always, but we're going to be covering volume. You already know what volume is? Well, then this should be a rather good refresher for you. And if you don't, then hey, pay attention. You might learn a thing or two, hopefully. Obviously, as I go along, please feel free to ask any and all questions. It doesn't matter when they come in. I might not notice them immediately if I'm getting in my ebb and flow. I might not realize that you typed something, but I will do my best to keep going back and forth and checking the chat box to make sure I am seeing your questions and answering them at the time that you ask them. Like I said, don't feel like you're interrupting me in any way, shape, or form. Ask the question as you feel it. That way you don't forget it later on and then say, oh man, I should have asked it and I forgot. But anywho, going to go ahead and start off by taking a look at some disclaimers. Just bear with me, guys. I'm going to read through the first one, then the next few thereafter. Going to go ahead and leave them on screen. Please read through them or screenshot them and read them later. But yes, please don't forsake them. So taking a look at the disclaimers now. Here we go. So, number one, this is our disclosure. Earn to Trade is provided to you for educational purposes only. Earn to Trade is not a financial services company. Earn to Trade does not accept any liability for loss or damage as a result of reliance on the information contained herein. This includes educational material, price quotes and charts, and analysis. Please be aware of the risks associated with trading the financial markets. Never invest more money than you can risk losing. The risks involved in trading are high and may not be suitable for all investors. Earn to Trade does not retain responsibility for any trading losses you might face as a result of using the data shown on its websites or webinars. The data and quotes contained may not be provided by exchanges, but rather by market makers. So prices may be different from exchange prices and may not be accurate to real-time trading prices. Any examples used are not a recommendation to buy or sell or a solicitation to buy or sell futures, options, bonds, or binaries or securities of any kind. The information and strategies and techniques discussed herein are the property of Earn to Trade LLC. They may not be shared or distributed to another party without the express written consent of Earn to Trade LLC. Any trademarks or copyrights referenced other than Earn to Trade are the property of their respective holders and not Earn to Trade LLC. All right, moving along, guys. I'm going to go ahead and throw a couple other disclaimers on screen. Please take a moment to review them and or screenshot them and save them. But once again, I'm going to let you guys read through these on your own. Alrighty, moving on to the next one. Here we are, same scenario. Go ahead and take a breeze on through it, folks. Read it over carefully. Take a screenshot, save it for later use. Do what you will. I will be moving on to another one here in a little bit. And moving along once again. Same as before, guys, please take a moment to review the disclaimer and or save it. And moving along still. This will be our final disclaimer, folks. After this, we get into the good stuff. All right. So like I said before, those of you that were the early birds that got into the room on time, that's good stuff. That's awesome. Today we will be discussing volume. We'll be discussing volume, what it means to us, how we can apply it to our charts, how it can be used, all that good stuff. And if you have any questions, obviously, as we go along, hopefully I can clarify them for you. And if all goes well, there's not many questions. We'll be through rather quickly. If there's plenty of questions, then hey, I'm yours. I'll be here as long as you need me. But if you don't know me, I'm sure most of you do by now, but if you don't know me, my name is Chris. I am a trader and mentor at Earn to Trade. I do the daily recaps as well as provide mentoring to our traders, as well as obviously run these webinars as well. So I'm pretty involved with the educational material and here at Earn to Trade. So suitably, this is my area. So like I said, please feel free to pick my brain as much as you like. I'll do my very best to make this a little bit easier and more enjoyable for you as we go through it. I know that sometimes covering all this information isn't the most fun, but it is arguably rather necessary. So without further ado, let's move on over to my charts and get started here, shall we? Let's see. Okay, wonderful. Timothy says it's a little bit rainy here. Hopefully my power does not go out. Oh, well, hopefully it does not. Stay dry, stay safe, stay under that roof. Don't get hit by lightning. That's not fun. Anywho, moving along, guys, here. So today, like I said, we will be discussing volume. The goal of this webinar is quite simply to just simply talk about volume, try to keep it as casual as possible while also as informative as possible. I'd like to, give some examples of what volume looks like, how to apply it to the charts, where it can be found, where it can be utilized, how it can be utilized, all that good stuff. So hopefully at the end of this webinar, you'll have a better understanding of what volume is, how you can use it, and how you can possibly benefit from it, and or the information that you have learned here. So moving right along into things, the first thing that I'd like to talk about is simply we'll start off with where volume, well, actually, you know what? Let's go ahead and start off from the very, very beginning. I'm going to jump back. I'm going to go ahead and remove an indicator here. 1 second, folks. Okay. So what I've done is I went ahead and removed the volume indicator that you may have noticed was already on my charts, because I'm going to start from the very beginning. A lot of you are using our platform, and that is absolutely wonderful. If you are using our platform, this part's going to be specifically directed at you. I'm going to show you exactly how to add volume to the charts. Now, if you are using a different platform, meaning you're using a different brokerage, what have you, a different price feed of some sorts, your process of adding volume to your charts obviously may be slightly different. However, it might be similar, so it is still worth paying attention. But those of you that are going to be using the Finnmark systems, and using our platform specifically to add the volume indicator, or any indicator for that matter. What we're simply going to do is we're going to navigate, once we have our chart open, okay, to whatever we have it set to. I currently have my chart set to the E-mini S&P 500, otherwise known as the ES for short. Got my price feed located, meaning I can see where price, I can see what price is done during a specified period of time on my charts. So I'm going to go ahead and scroll over to the bottom left corner of the screen, where I'm going to find three little icons here. The top icon is a little crosshair. The icon below that is a little pen tip. And below that still, we have a small little graph icon. I'm going to go ahead and click on the small little graph icon. After doing that, everything's going to get all blurry. Don't worry, you don't have glaucoma. It's all right. We're going to go ahead and go over here to the bottom center where we have an Add Section and Close button. I'm going to click Add Section. Bink. After clicking the Add Section button, I'm going to go ahead and click Add Indicator. Now that it says blank, I'm going to click on that blank. And I'm going to go ahead and scroll down to the very bottom here, in this case, because we're going to be using volume today. But as you can see, there's quite a lot of other indicators here readily available for you to apply to the charts, which we will talk about at different times. Or you can simply go through our pre-recorded educational section and you can check out the lessons that we already have on all of these listed indicators. But once again, so scrolling to the very, very bottom of this chart, after clicking on the blank, I have volume. I'm going to click that button. And as you can see with your blurry eyes here at the bottom, it has gone ahead and added the charts. But first, I'm going to go down here to the bottom. I'm going to click Close. And we are left with charts that have been shifted slightly because it is now accommodating the volume indicator. The volume indicator here at the bottom. So I'm going to go ahead and drag this down by clicking on this gray line, this gray horizontal line. Once you mouse over it, you'll notice that you get an up and a down arrow. If you click and hold, you can drag this up, down, and you can fit it to exactly what you deem the most suitable for your trading preferences, that is. But anywho, so here we go. Now we've got volume on our charts. We can view what price has done in terms of the actual movements of price on our candlestick charts that are viewable above, and then below we have some bars illustrating the volume. So where what makes volume useful? How about we start there? What makes volume useful? Well, volume is useful because, quite simply, volume can be applied on any time frame, on any chart, any asset, pretty much any scenario. You can apply volume to it. So as you're currently seeing right now, the charts are set to 15 minutes. If I go down here and switch it to, say, hourly, well, what do you know? We have volume. It's down here at the bottom. It has adjusted accordingly, but we have volume. Volume still applies. We can still read it exactly the same way, which obviously we're going to get into. And if we switch on over here to 6 hours, same thing. We still have volume. Okay, so nothing too crazy going on there. We're going to go ahead and switch ourselves back here. Back to the 15 minutes. So back to the 15-minute charts we have. Now, the next thing that we're going to talk about is we're going to talk about, let's see, we're going to talk about first off, we're going to move on into what is volume. What is volume? Because there's two different areas that most traders that have found their way around the site have noticed that we tend to focus on, and that's futures and Forex. Now, the difference between trading futures and Forex, obviously there's differences between the two, but what we're going to focus on today is the differences that volume has pertaining to both of them and how they can be possibly applied to your daily trading needs. So we're going to start off by talking about what volume is for futures. Now, simply volume, as you see down here by these bars, is simply a measurement of the number of contracts traded at a given time. Okay, it's the number of contracts traded at a given time, and because with futures, all contracts traded go through a centralized exchange, we're in a situation where it doesn't matter what broker you're using. It doesn't matter if you're using our Finnmark systems. It doesn't matter if you're using something different. If you are trading futures, your volume readout will be exactly the same as mine. Now, with Forex, okay, I can't even go to show you with Forex at the moment because we don't even have a volume indicator that is applicable to our Forex stream, so I'm not going to switch over to it. With Forex, it's a little bit different. A lot of traders will say, generally speaking, that volume in Forex is a little bit more, I'm not going to say that it's irrelevant, but many traders will argue that adding volume, the volume indicator to trading Forex is a little bit less useful because it's a little bit less precise. And the reason is trading Forex, it's not all through a centralized exchange like futures are, excuse me, forgive my improper grammar there. And because of this, the brokerage that you're trading on, the volume that is being displayed is going to be displayed by updates in tick versus an update in a contract. It's going to be displayed every time there's an update in tick change in volume. That's going to be displayed on that's pertinent to that broker. That doesn't mean that it's going to be the same on every single broker, because each broker might have a different price quote, because it's not all trading through one centralized exchange like futures are. And as a result, you can come up with different displays of volume on different brokers and obviously different results. Price might be higher here, price might show more volume on this broker, might show less volume on this broker, and none of them are wrong, but they are all in fact different. And as a result, it makes it a little bit less reliable, on top of the fact that, like I said, it simply measures tick change in volume. So it's more of a volatility measurement than an active exact measurement of how much of something has been traded in the futures world, where we have volume measures exact number of contracts that have been traded, so to speak, or is based on the exact number of contracts that has been traded. But put simply, as we look down here to the bottom, we can simply ignore the colors. Now you can set these colors to whatever you want. You can have the red. You can set a red candle. I'm sorry, red candle. You can have the red bar represent a volume bar that is larger, or you can change it so that the blue bar represents the volume bar is larger and the red bar represents the one that is smaller. It doesn't matter, but the most important thing that we want to remember, it's all personal preference at that point, but the most important thing that we want to remember when understanding what volume is that the larger bar down here is an indication of an increase in what is being measured. It's an increase in the volume. So we see this very small bar followed by this very large bar in this case. And this actually happened near the cash open. As you can see, this happened, if your eyes are acute, this happened right at 9:30 at our cash open. And this is very common and characteristic that during our cash open, we see a large influx in volume, and then it generally dwindles out towards the center of the day and then rises yet again towards the end of the day. But once again, the size of the bar, the size of the volume measurement for that period of time is directly indicative of an increase or a decrease in volume. The larger the bar, the more volume, the more contracts, in this case, because we're talking about futures, the more contracts have been traded. The smaller the bar, the fewer amount of contracts have been traded. So this is a very strong indicator of how much of something is happening and how liquid the markets are. And that in and of itself is a very useful piece of information to us as traders. We want to be trading, generally speaking, most of us want to be trading during liquid portions of the market and not so much during non-liquid portions of the market, as it might be a little bit harder to get filled during a non-liquid period. If there's less people trading, it's going to be a little bit harder to push orders through, or could be potentially a little bit harder to get orders through, get orders filled, and what have you. During liquid portions of the market, you have a lot more people trading, a lot more activity going on, and a lot more possibilities available to you, generally speaking, at a faster speed as well. So now that we've talked about volume in terms of what it is, what it measures, when it can be found, we've talked about that volume is applicable to any market, any time frame. Just simply, volume can be applied anywhere. And it doesn't have to be applied only to Forex or futures. It can be applied to either or. It can be applied to other things as well. But it is important that we understand how it's measured when we start changing what it is that we're looking at. Once again, with Forex, volume changes versus volume is a measurement of tick changes, whereas with futures, volume is a measurement based on the contracts traded at that time between all brokerages. Whereas once again, with Forex, it is a measurement of that individual broker that you are trading on and nothing more. It does not measure anything outside that individual broker with Forex. With futures, it is everything across the board. Doesn't matter where you're trading. We're all going to be viewing the same volume. Forex, not the case. Makes it a little bit more difficult and a little bit less, I don't want to use the word less reliable, but many traders will generally use that to describe it in that situation. So we talked about how volume is higher in this particular situation. As I mentioned, it is the cash open. If you follow the the crosshair all the way up, you'll notice that this is 9:30. The cash open is 9:30 and closes at 4. So during the cash open to close, you see a lot more volume. And as we scroll back, you'll notice that there's all these heavy portions where these candles, I'm sorry, these keep calling them candles, where these bars are significantly larger than everything around them in the space between. That's because all of these large portions represent the cash open and close, okay, where the majority of our activity and the majority of our volume is. All the way through, we can scroll through, and without even looking at the date, I can go back here and say, hey, this is probably 9:30. Let's see. Oh, gee, well, you know, it is 9:30. So let's scroll all the way back. The next big bar, where does it start? Hey, is this 9:30? Oh, it's 9:30. What do you know? Let's see where it stops. Stop at 4. And let's see. Oh, gee, look at that. Stops at 4. Where does this one stop? Oh, it stops at 4. Where does this one stop? Oh, look, that stops at 4 as well, and so on and so forth. You get the idea. Point is, there is a lot more volume going on between the cash open and close than the hours outside of it. That is a valid piece of information to pay attention to. Those of you that are heavy volume seekers and prefer to trade during heavy liquidity portions, as volume is currently showing us where the most liquidity is, and that would be between the hours of 4. I'm sorry, between the hours of 4:30, between the hours of 9:30 a.m. Eastern Standard Time and 4. That's 4 p.m. Eastern Standard Time. But anywho, there is a lot of different methodologies that can be applied to volume. There's a lot of different ways we can use volume to trade, but one of the most common ways that traders tend to use volume is a measurement of strength, so to speak, of particular breakouts. So we're going to go ahead and go back here, and I'm going to see if I can find a good example of a nice break, and we'll see if the measurement of that break is rather substantial and can be measured with that volume. So let's see what we have here. All right, we're going to use this right here. Let me try to zoom this. Actually, we'll leave it. It looks a little bit better when we have it zoomed out. Timothy Jackson says, so why does volume go up and down in the middle of the day? I'm going to pause for a second, guys, just to answer a question, possibly get caught up here and answer them, like I said, as I see them coming in. Volume goes up and down in the beginning of the day because obviously at 9:30 when the market opens, you have the most amount of people anticipating the availability of trading for them, and the largest number of people entering the market at 9:30 is the easiest way I could have worded that. You have the largest number of people entering the market at 9:30. As we work towards the middle of the day, a lot of traders go towards lunch, and we see this almost smiley face formation. And then towards the end of the day, people start coming back from lunch, and we see people fulfilling orders and last-minute orders, and almost that FOMO kicks in when we have a lot of traders trying to reach their daily goals that possibly haven't already get there, and it encourages trading activity to kick up a little bit towards the end of the day. So we have an influx in trading in the beginning of the day when the market opens, large surge, and then it kind of mellows out as we push towards the close of the day, or towards the middle of the day, which is lunch, and then we start kicking up again when people start coming back from lunch and work our way towards the end of the day where people are trying to get those last-minute orders in before the cash close. And Timothy says, so overnight there's just not many people trading. That is correct. So while trading might be going on, the volume in and of itself, as you can see by simply looking at these bars, is substantially lower than the volume during the cash open to cash close. And he says, is that just because most people trade the U.S. session on this market? And yes, that is absolutely correct. That is absolutely correct. You might see something different in a market that is more geared towards, say, the Asian market or the UK. But yes, that is absolutely correct. Says, okay, makes sense. Thank you. You are absolutely welcome. So going back to what I was talking about here, I'm going to go ahead and draw off a level of support that I've noticed by taking a peek at this market, and we're going to look at a breakout that happened and and we're going to talk about how volume could have possibly given us an indication into confirming this breakout, if you will. If it was when we talked last week about support and resistance in terms of trend line, what what can be deemed as a clear-cut successful breakout or a fake out, if you will. Volume can help filter out the fake outs. Volume can help filter out the fake outs and can help identify those true and blue breakouts and allow us to have a better expectation if the market is going to continue in that fashion, below that possible area of support or resistance, by just simply, like I said, paying attention to that volume indicator. So when I go ahead and take, let's see here. All right. Hopefully this is rather visible for everyone. I might change this, make it a little bit clearer. Let's do gold. All right, that makes it a little bit easier. Okay, so what I've done here is I've used a goldenrod zone to outline an area of support in the market. Now, I'm not going to go too much into detail on support or resistance. Obviously, that is not the goal of this webinar, but essentially when I say support, I'm talking about an area where price has come down to, found strength, and had an inability to continue moving lower, and then in turn started moving up off of it. We can see very clearly that at this location, that this happened, quite a few times. We had price come down. Ooh, one second here. We had price come down here. All of a sudden, we found some strength, began more or less moving sideways off of it. I don't know why I keep shifting the lines, but anyway, we started moving our way sideways off of it and continuously found enough strength to actually go up and change direction when we had a whole lot of bearish momentum going on before this point. Move sideways, move sideways, move sideways, found strength, and then what do you know? Over here, all the way to the right here, we have a situation in which price has now broken. Now, we talked about last week that I like to determine a break by, what I classify the word break is when I see an area that has a candle close beyond it, whether it's an area of resistance or support, it's a close beyond it, not just simply a temporary push beyond it. The reason why I do that is obviously it's going to be more up to trader discretion at this point in time, but I feel that filters out some of the false moves, the quick jitters in the market, where you might have a quick spike below and it has caused a wick below, even though price didn't actually end up closing beyond. And you might, it avoids me getting into situations where I might, in this situation, had it just been a quick wick and I sold early, before waiting for that confirmation of that close, I might have got myself caught up in a situation where price actually wasn't breaking and continued on higher, and I would be into a losing position. But in this example, what do we have here? We have a situation where we had support, and finally a very powerful candle came along right here, this big red candle, huge red candle here, and it closed well below this area of support where the market had previously been bouncing up off of multiple times. Now, if we follow this candle all the way down, what do we notice? Look at that. The candle before it was a small candle, meaning there wasn't much volume, and then all of a sudden, very large, powerful candle, boom, has closed through. So we have a candle that has closed through, officially broken our area, and we're trying to use volume to give us confirmation on whether this is a strong breakout or not. And how are we going to do that? Well, one of the ways that we're going to confirm a breakout and its validity is by paying attention to how much volume has entered the market around that break. And in this situation, there is a large spike in volume during that break. Now, the next thing we want to do is pay attention to what volume is doing thereafter. If volume continues to increase thereafter, the expectation that that break is going to hold is all the stronger. So in this case, we had the candle that broke, large body candle here, went ahead and closed below. And then we had this more of a, let's see if I can make this easier for you folks. All right. So after the candle broke, we have this quite steep increase in volume overall. Now, obviously, every candle wasn't consecutively higher than the rest, but the majority of the direction of volume in and of itself was, in fact, increasing until we started decreasing hereafter. This would have represented the pinnacle right here. Timothy says, so if you get a huge volume candle on a break, does that always mean it will keep going further? No. In trading, nothing always means anything. It is important to understand that. But if we have a large spike in volume during the break, the general accepted notion is that we will expect to see price continue further in whatever direction that it just recently broke, as there's a lot of volume in the market being added during a period that it has finally pushed through an area of support that was no longer holding it. And if there's all that pressure built up in the market, we can think of it as added momentum. We can think of it as a bunch of built up kinetic energy that needs to go somewhere. And in this situation, obviously, where we're breaking downward, a large increase in volume, we're going to continue to expect it moving downward. Now, does it mean it's always going to do that? No. There is going to be times where the market might have a large increase in volume and then completely flip back around the other way. Obviously, we want to be aware of everything. There's nothing in the market that's ever going to be 100%, but there are things that can get us close enough that keeps us happy. But moving on back to what I was saying. Well, he's got something else for me. 1 second. I see that this one also looked like it ended its move right at the end of the day. I wonder how often that stops it from moving on. Essentially, he's talking about, if you look at the volume here, folks, he's talking about, well, I got to go back to my crosshair. There you are. The last large volume spike that we had, or in terms of, relative, obviously, all of the volume next to it was much smaller. The last large volume bar we had happened to be at 4 o'clock, which was the close of the day, and that is not a coincidence. Like we already talked about, the volume is higher at the beginning and the end of the day and a little bit lower in the middle, and outside of the cash open and close, we have much lower amounts of volume. So what happened at the end of the day was simply the volume went ahead and minimized drastically after 4 o'clock, after the cash closed, and we were left in a situation where the market kind of meandered sideways. The candles were rather small, and there wasn't a whole lot of change in price, and we kind of just meandered. Instead of waving, finding clear areas of support or resistance or directional heading, we kind of just had all of these small candles just gradually moving sideways. So it is not a coincidence. That's what he was saying again. Let's see. Does it also make a difference where a breakout happens? He said it looks like he's got. Hold on, I got a whole 100 questions here. Let's see. I see that this one also looked like it ended its move right when the end of the day happened. I wonder how often that stopped it from moving on. The lack of volume obviously is just simply going to be a lack of volume in and of itself. I don't think the end of the day is necessarily going to stop or stop it, although it might impede its progress as there's less action happening at that time, if that helps answer your question. And he says also, does it make a difference where a breakout happens? Do ones in the earlier part of the day work better, or does it matter where it is? Try to soak up as much information as I can. I'm probably I might have to pause here and keep going. I'm kind of messing myself up by answering all these questions. It's kind of messing my flow up. Not your fault at all. Like I said, keep asking the questions. I'll just go back and I'll go back and answer them just at a later date, most likely. But anywho, so last question that we have here was, does it matter where the breakout happens? In this situation, we had a breakout happen. We had a strong surge in volume a couple hours. Well, in this case, it was only an hour before the close. So an hour before the close, he's saying, well, what if that happened over here at the cash open? Say we had a break right here. Would it be a little bit more reliable? Well, in this situation, had it happened earlier on in the day, we would have an expectation that there might be a larger move as a result, because there's going to be more action in between this period than there is going to be after this period once the market closes off at that 4 p.m. window. So had it happened at the beginning of the day, the answer is just simply yes. We might have an expectation to see more action or a better response to that break than we would towards the end, when more people are leaving the market and there's less people moving it around, so to speak. But going back to what I was talking about here with this breakout that we have a situation where the candle went ahead and closed underneath, clear break. We look down here, spike in volume. As we can see, volume increase at this time. And because of the increase in volume and the break, we could consider this a confirmation that this is in fact a break. This isn't a fake out, and we could continue to expect price to move beyond this point because of the spike in volume and the continued spike thereafter. And what do you know? Price did continue to tumble down quite a ways and then actually moved sideways for a little bit, and then more or less began meandering upwards after all of this kind of wore off, after the volume more or less died. So volume giving us a very clear-cut example of helping confirm the validity of a breakout. We're going to go ahead and move a little bit farther back on the charts or possibly to some other time frames and see if we can't find some more examples here of using volume to help confirm a breakout, which, like I said already, is one of the most widely accepted and considered the most valuable use at times, commonly anyway, of using volume in our daily trading. So I'm going to go ahead and get rid of some of these guys here. There we are. And then we're going to move back a little bit farther on the charts, like I said, possibly other time frames, and see if we can find another example of volume being useful to us. Or possibly, maybe I'll find an example of volume not being useful to us and failing us. But we shall see. Let's see what we have next. Let's see what we have here. This is a rough example. This is a rough example, but I want to use it anyway because it is an example nonetheless. So we're going to zoom this in a little bit here. See this platform where the market did in turn find a little bit of support. Let's go ahead and draw ourselves a line here. I'm going to draw it in white this time and make it a little bit easier to see. So a little bit easier on the eyes there. So we have a situation in which price was moving downwards, and then all of a sudden we found support right here. After finding a little bit of support, the market then tried to work its way upwards. Unfortunately, it didn't succeed. Sellers stepped in. They found a little bit of resistance. A wall was created, and price then began to move back downwards. Now, it was at this point that we encountered the same area, the same price that initially created some support that initially caused the market to bounce upwards. Okay, it's at this point right here, somewhere near that 2665 location, found a little bit of support at this time. Well, the market worked its way down to it and actually passed through it. So let's go ahead and take a look down here below and see if this breakout candle has an increase of volume associated with it. Now, once again, every example is going to be as beautiful as the previous, but this has something to take from it nonetheless. As we follow our eyes down here, I connected it with a nice white line for us. We can see that this candle has an increase in volume, and it is a substantially large increase in volume compared to everything else around it. If we were to follow it all the way over, it's larger than most of these volume candles that you see here during the cash open and close. So we're given a situation in which the candle has closed below, has substantially and clearly, not only has it closed below, but it has reached a new low price that it was unable to even touch previously after finding support around this level. It has closed below, and we have an increase in volume. Well, what does that mean? Well, volume should be telling us that this is confirmation that this is a real breakout, and we should be expecting price to fall. Well, let's see what price did. Well, it looks like we went down, went sideways a little bit, went down, and continued down a little bit lower. So in this case, if we used volume to confirm that this was a real breakout, we would have been correct in our identification and our expectations that price should continue lower due to what volume is showing us. We have a very heavy spike in volume, on this candle right here. Very heavy spike in volume, and once again, the direction of price is only increasing where this candle is larger than the three before it, arguably the last four before it, but we do have an increase in volume in a bearish candle that is only the third one after breaking. All the more reason to expect price to continue falling. Very, very bearish sign. And what did price do? Now, it did continue falling, but why does it look like it slowed down all of a sudden? Well, let's see what time this is, shall we? I didn't mean to erase all that, but we'll make do. So what time is this? Right here, it seems like price just kind of started becoming very small, meandering sideways. So let's see what time this is. 16. There we go. It is 4 o'clock. As you know, the cash session has come to a close. And as a result, the amount of trades being executed has diminished greatly. And as a result, the market's exaggerated moves aren't nearly as exaggerated, and the directional heading isn't nearly as exaggerated as it was before, with more people moving the market. So it's not a coincidence that the market went ahead and slowed down. But even so, it is still important to note that the directional heading here, even of this meandering market, the momentum carried over from that large increase in volume and this bearish pressure from this breakout did still carry over during the slower volume time. The market was just moving just a little bit slower, but still in the expected direction. So nothing too wrong about that. But Timothy says, so if the market is trending down, it looks like a breakout lower would be better maybe than an upward breakout in a downward trend. Let me read that a couple times here to make sure I've got his question. Market is trending. Oh, he's just simply saying, so Timothy's saying if the market is trending downward, would a breakout lower be a better direction to look for in terms of, hey, should I be looking for those sells, trying to take advantage of a low breakout, breaking out of support while the market is moving downward? And once again, it's going to be open to trader interpretation, but simply put, it would just be following the trend. You would just be going in the direction of the already overall trend. You're selling in a bearish market or you're buying in a bullish market if you were to reverse the scenario. And that is widely considered to be a smart decision. So, but once again, it's not what you have to do. It's just going to be open to what you feel is right and what you have the most success with. But that is definitely something you could do and people do every day. Absolutely, absolutely. But anywho, so we have a scenario where we had a beautiful breakout. Now, had we moved this back, a little bit farther, this large increase of volume, had this happen, say, over here at, say, 10:30, instead of all the way over here at, at 3:45 or so, had this actually gone ahead and happened a little bit earlier on in the day, there's a good chance that this bearish momentum would have carried the market quite a lot farther down than it was able to do leading up to the close, where we ran out of momentum and the market kind of tuckered out a little bit early here. But let's go ahead and move backwards and see if we can find another example. Hopefully one on the bullish side. Might not be able to, but we'll see. Had a lot of bearish momentum in the days that we're reviewing. But going to go ahead and see if we can't find an example of a resistance level being broken and the market going up, just to show you that this obviously goes both ways. But if I can't, once again, remember, we are just simply going to inverse everything that I said. Increasing volume is increasing volume is increasing volume regardless. If we see a breakthrough resistance, and an increase in volume, that means larger volume bars down here at the bottom. That means the same thing to us, the same expectation to us as what we were just talking about. It means we're expecting the market to continue on in that direction. It's adding validity to the break that we just witnessed. So the large volume bar at the bottom doesn't in and of itself indicate that the market is going up or down. It's just an indication of the power of the move that just happened. Think of it that way. So if the market breaks resistance and we have large volume bars at the bottom, then we're going to have an expectation that the buyers are hitting pretty hard, and we're going to expect that market to continue to rise and that it is a real breakout. Just the same applies if we have a break of support like we were just talking about. If the market breaks and closes below an area of support and we have a large volume bar down here at the bottom and larger volume bars thereafter, that is an indication that of the power of the selling going on, and we're going to expect the market to continue selling thereafter because of the large volume supporting it and the confirmation of the break that we were just given. So large volume bars are an indication of a continuation, if that makes sense. But anywho, or indication of a possible continuation is what I should have said there. But let's go ahead and see if we can zoom back here a little bit more. Let's see if we can find ourselves a situation. We could use this. This is going to be a real rough example, but we're going to go ahead and use this. All right. So if I go ahead and draw a line off here near the 2710, okay, drawing a line off here at the 2710, we have an area of the market used as support initially. On our first approach, the market worked its way down. We found a little bit of strength, a little bit of support. The market kind of plateaued on top of it, then went ahead and fell through. We're not too interested in the fall through portion because, like I said, I was trying to find an example of resistance so we can do an example of each here. But the market went ahead and fell through. After falling through, what do we have? The market began treating it as an area of resistance. We worked our way up to it, the area that we had previously got stuck on top of. Now we're getting stuck underneath. The market rejected, sellers took control, we fell down shortly, worked our way back up. We had a couple tests where the market actually tried to get through it, failed, tried to get through it, failed. And then finally, big, powerful, bullish candle, big buying candle here. Went clear through, closed way up here, big, powerful, bullish candle, closed through. And if we follow this down, all the way down, we'll notice that during this big, powerful bullish candle, there was a large increase in volume. Very large increase. This candle right here happens to be the most active and largest volume bar that we have during the entire cash open and close session that day, or just the entire day in general, regardless of cash open and close. But we have a very large candle here, very large, powerful close through this. How are we going to interpret this? Well, if we wanted to make sure that, we just want to make absolutely sure that in this situation, that we aren't being faked out here. Say we're looking to buy. We were waiting for the market to work back above this level, and we were looking to buy in hopes of anticipating some retrace of this large bearish downturn that we had earlier on. If we were looking to buy, but we wanted to make sure, wanted to look for that confirmation, we'd look down here at the volume bar and say, oh, look, a large increase of volume happened at the same time that we closed through. Now, once again, this isn't the cleanest example because ideally what we would like to see is we'd like to see increasing volume bars after this as well on a general note. Every single candle doesn't have to be higher, but in a perfect world they would be. Or I'm sorry, every single bar doesn't have to be higher, but in a perfect world they would be. Unfortunately, that's not what we had, but we did have a very powerful volume spike and close above this level. And because of that in and of itself, we can interpret that as confirmation that this level has now broken and we are no longer in a situation where we're expecting price to be stuck up underneath this level. So we could look for an opportunity to go long here. And had we done that, what do you know? It actually, this area where that candle actually closed off and we had that large volume spike working our way back above, this area actually became an area of support. We never really fell back below that level for some time. So a buy in this situation could have netted us some pretty sweet gains at different points. It looks like we might have gained at least about 15 points or so off of that in a very short period of time, relatively speaking, a matter of a couple hours. But anywho, this is an example of buying or looking for confirmation when a resistance level is broken. In the event that we want to buy, we want to use that volume as an added layer of confirmation to possibly look for the buy that we were talking about. So I'm going to go ahead and keep moving back and look for some more examples. Hopefully this is clicking. Hopefully this is starting to make sense now. And hopefully the word volume and the volume indicator isn't so scary, because it really, really isn't, folks. It's actually quite simple. It's actually quite simple. So hopefully I'm doing it some justice here. Timothy Jackson says, yes, it is. Thank you. I feel like I have a good handle on it now. Wonderful. Wonderful, 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 wonderful. Let's see what we have here. Let's see. Hopefully I can find another good buying example for you guys. I'd really like to do that. Really like to do that, but I can only give you what the market has provided me with, unfortunately. So let's see. Let's see here. Good news is I am actively looking for these. These aren't pre-planned levels. I didn't say, okay, before this webinar, I'm going to go ahead and use this. That's why I like to keep things as casual as possible, because you should be able to gain a little bit more seeing me do this and seeing me actively look for these levels without actually knowing exactly where they are ahead of time. It might help you, feel a little bit more comfortable or associate you more with the process of looking for these yourself when you go ahead and do it. You might realize, oh, I'm not always going to be able to find one perfectly the first time around. I'm not always going to, the market has to provide it in order for me to find one. What do we have going on here? We got a large increase in volume. Volume is increasing. In this situation, Actually, we're going to use this as an example here. This isn't going to be a buy or a sell example, but this is going to be an example of when we can use volume to possibly get ourselves out of a position that we're already profitable in. Because this is also important. You know, we can make a trade where making a trade is only half the battle. Getting out is the other half. So if we have a position that has gone our way initially and we are in the profits, our next goal is to conserve those profits and actually get out with those profits. Just because we have profits on a position doesn't mean anything until we actually lock ourselves out. While that position is open, we haven't actually realized any profits yet. So figuring out how to preserve our profits is extremely important, and we're going to use volume here to show you just how we might be able to do that. So when we take a look right here, let's go ahead and draw some lines. We're going to draw this line all the way up. I'm trying to draw as straight of a line as I can. There we are. So we follow this one all the way up. I connected it with a nice pretty white line. We have a situation in which it looks like we had a breakthrough support that was previously resistance. And I'm drawing a very sloppy line, so bear with me, I apologize. But what I really like to focus on is this area right here. Right here in this ellipse. So as you can see, we've got a situation in which we found support working our way down. The market works sideways, bounced itself off. It's not the strongest area of support in the world, and it doesn't have the most tests available to our eyes at the present time. However, it is indisputably an area where the market has fallen to, bounced, and worked its way up from. After doing so, or working our way up, we went ahead and pivoted, came back down, sellers, hey, we're not done with this, and they came through hard, very powerful bearish candle, went ahead and closed well below. At this point in time, we did have an increase in volume. Price increased in volume, an indication that, hey, this, once again, is a real deal break and possibly not a fake out. So what do we have here, and what do we want to look for in our expectations? So say we get in for our sell. We get in for a short. So we start looking for some type of sell. We're short in the market around this location, which happens to be around that 2667 location, around that 2667 location. So we jump in for our sell. Say we jump in right here. Okay, boom, we're in. So we get in, we get a beautiful fill. We got in, we waited for confirmation due to volume, showing us that this isn't a fake out, and we're in to go down, like I said, right here. All right, this is starting to get messy, so I'm going to clean these lines up real quick and do that one more time. So here's our break, here's our line, here's our support that has broken, and here's the area of question. And we're going to use this arrow here, this red arrow, to indicate where we got in for a sell. So we got in for our short right here, and that's going to be more specifically, we'll say right there. So bam, in for our sell, in for a penny, in for a pound. So we're in, and we want the market to tank. Why? Because once again, we're in for the short. We waited for confirmation with our volume. Volume showed us good stuff. We had an increase in volume at the time that the break happened. Wonderful, wonderful. So we're in. Now we're going to keep monitoring this volume. And what do we see down here? We're going to monitor this volume, and we say, okay, look, our next candle came along right here. Next candle came along, and what do we know? Volume increased. Now, price is actually rising here. We almost have a bit of a pin bar formation. Price is actually rising, but not really. We haven't gone ahead and set any new higher highs. We haven't worked our way back above that level, so we're not going to get spooked just yet. We're going to ride our trade. We're going to hold on to it just yet. Nothing too crazy has happened, and we're going to hold on. So we're going to hold on. Price volume is increasing despite price having comfortably broken out. So we hold on to our position, and we are well rewarded when the next candle comes. Once again, boom, hard increase in volume yet again. We have a very powerful bearish candle. Now, what do we have here? Next volume bar thereafter, next candle thereafter, what do we see? Okay, well, we see the candle slows down a little bit. We don't set any new lows. We don't set any new highs. We actually don't do a whole lot of anything. Much smaller candle, and as you would expect, the volume has decreased in relation to the volume bar before it. Okay, good. So volume has decreased. Now, what does this mean to us? This is when we're going to start paying attention. Now we're starting to see, instead of sloping upwards, whereas these first three volume bars were increasing, now it looks like we're starting to possibly slope downwards. So we're going to go ahead and give it another candle and see what happens. And oh, what do you know? Next volume bar, next candle. We do continue to fall in terms of price. Price does continue to fall, but volume actually gets lower. And we're starting to see some really weird action. We're starting to see a longer tail on the bottom, a shorter tail on the top, but we're starting to see fight, almost equal and opposite fight. We're not really hitting any new lows. This big, large candle actually worked down to almost as low as this candle had. So we're not really getting a whole lot lower. The market seems to be tuckering out. It's around this time here that we want to start considering what do we want to do with our position. We've made a nice gain, okay? At this point, had we gotten in near that 2670 location, 2667 location, at this point here, if we were to follow this all the way across, you'll notice that we are sitting somewhere around that 2753 location. So we've made a nice gain in terms of points. Do we want to continue to hold on while the volume continues to die off when we start to see this weird action? Well, realistically, this is going to be open, obviously, to trader interpretation, but my answer is going to be no. I don't want to hold on anymore because I don't have a real expectation. If the volume is going to continue to die, I'm not really going to expect to see the market continue to fall at the speed that I'd like to see it at. So what I'd like to do at this point is say, okay, here's my gain. Actually, let's do that one in green. There we go, a little bit easier on the eyes. Boom. So we're going to go ahead and say the distance from our 2667 location all the way down here to our 2753 location has locked in, but we're starting to see down here at the bottom, we're starting to notice down here that the volume is decreasing. Volume is decreasing, and the effect that it's having on price is we're really not getting any lower. We're starting to have a great difficulty getting any lower, and if anything, it looks like the market might be getting ready to start retracing and working its way back up. It's because of paying attention to the volume down here and what the candles are doing in cahoots and coordination with it that I'm going to say, hey, at this point, I'm probably going to go ahead and close out my profits, take what I've got, and go ahead and wait till the market does something advantageous for me again and call this money in the bag for me and just lock it all in and be done and out here, somewhere around that location. Having ridden a nice little ride downwards, nice little short, taking advantage of paying attention to volume to get into the trade, and then taking advantage of volume to get out of the trade and preserve the profits that I have gone ahead and made. Make sense? That's an example of volume being useful to get into positions and an example of how volume can be useful to get out of positions should it start looking a little bit questionable. Now that's good stuff there as well. Let's see if we can find some more stuff here for you. Actually, you know what? This is what I'm going to do. We've covered everything. We've covered examples of volume helping us get into positions that have broken through resistance. We've covered how volume can help us get into buy breakouts, and we've covered how volume can help us get into sell breakouts, get into those bearish breakouts when the market is breaking through an area of support. We've talked about that as well. We've also talked about how we can use volume to get out of a trade that we're already in order to preserve our profits, or we've also talked about how we might be able to use volume to avoid a bad position or in case volume goes against us. Let's see what we have here in the chat box. At this point in time, guys and gals, of course, if you do have any questions, definitely feel free to ask them. If not, if you feel that you've understood everything, I'll take your silence as as a pat on the back to myself in that you actually understand me. If you don't understand me, if it sounds like I'm speaking in hieroglyphics, then definitely feel free to ask, and I will do my best to clarify anything that I've already said. But if everything came across clear and we feel like we're on the same page, you don't have to type anything at all. I like to make this easier for you as possible. We are always available. Obviously, you can always schedule a mentoring session with us at any point in time, obviously, that we are available for you. We can get you scheduled in there. Just contact us and say, hey, I'd like to a little bit mentoring on this subject or that subject. Timothy says, I didn't even notice that it's been an hour. Wow, that went quickly. That was excellent, Chris. You seem to know your stuff. Thank you very much, Timothy. I do stumble over my words quite often, so please bear with me, guys. But I do try to keep things as casual as possible. I feel that it creates a little bit better of a learning environment for you guys if I can feel a little bit more relatable to you. And that's essentially what I try to go for. I try to keep it a little bit more fun, a little bit more free-spirited, but sometimes I do stumble over my words, and for that I apologize. But it seems like everybody has grasped the general concept of what volume is. how it can be used, how we can apply it to our daily trading, and the differences of what volume is in Forex versus futures. We talked about the tick change being the measurement that is used for Forex and how it is on decentralized, or how Forex in and of itself is decentralized, and that affects the measurement only being applicable to the broker in which we're trading. Whereas in futures, it tends to be a little bit more reliable because everybody everywhere is seeing the same exact readout, because for futures in and of itself is centralized. But other than that, guys, like I said, if you have any questions past this point, we are always available for contact. Just because the webinar ends doesn't mean that we're running off into the dark caves and you'll never hear from us again. That's not at all how it works. I do enjoy helping you guys as much as I possibly can and helping you, along your trading journey in any way, shape I can. All of us here at Earn to Trade do. Other than that, though, folks, like I said, I don't want to keep repeating the same words over and over. I start to annoy myself. It has been a pleasure, as always. I do look forward to seeing you all back here, whether you're joining me for my market recaps or in my next webinar. Other than that, I will see you all soon. I said it again. Cheers, everybody. Have a wonderful Tuesday tomorrow, trading the markets. Best of luck, and I will see you all soon. Cheers, everyone. Over and out.